Good morning, everyone. Welcome to the Traction Financial Partners 2023 Q3 recap and economic update. I'm Evan Barnes, founder and executive vice president of Traction Financial Partners. With me is wealth advisor Shane Wolfe and head of financial planning Drew Barnes. And we're excited today to share with you a recap of the third quarter of 2023. And as well as some other economic updates and looking forward into the fourth quarter and even into 2024. And we'll get rolling. There is a chat box at the top of the screen that we will be taking and answering questions at the end of the webinar. So if you want to type in questions as we go along here, we will be answering those. This is also being recorded so that it'll be posted to our website at tractionfp.com. And then we'll also be emailing this out so that you can share with friends, family, whoever wants to get an update from us as well. So we'll get going here and go through the agenda. All right, so today we'll be covering year-to-date capital market returns, starting with equity returns and how the stock market's been doing. As part of that, we'll do a debrief and kind of deep dive on how a lot of the returns this year have been concentrated into 7 stocks versus the rest. So we'll look at the magnificent 7 stocks, S&P 500 index concentration, valuations, and earnings. Look at a chart and how the S&P 500 individual stocks are doing compared to the index. We'll look at the style box and asset class returns. Part of that's going to be how our stock prices relative to their all-time highs. We'll also get into fixed income returns and key interest rates, historical perspective on when yields rise, look at commodity returns, understand the impact of changing interest rates, inflation update, talk about the consumer. We're a consumer-driven economy and look at the consumer savings and borrowing rates, credit card balances. And as we get into 2024, it's important to look at election year returns, risks associated with that, historically, how the market's moved during election years. And so we'll get into all this and get rolling into equity markets. All right, as we look at this chart, this is through October 6th of this year. So how the stock market, how's it done? So you can see different indexes that we track here internally as part of our investment committee and looking at the year-to-date returns, which is the middle column there. Some key indexes that I wanted to point out. The Dow, okay, the very top one there, Dow Jones Industrial Average, year to date, up about 2.5%. All right, go 2 column to your right, you can see just as a comparison how we did in 2022 on the Dow Jones. And then on the far right-hand side is going to be the 5-year average for the Dow at 7% per year. All right, so it's been a pretty muted year in terms of returns on the Dow. And the Dow is the one when you're watching the news and the financial markets, they quote the Dow quite often, saying, hey, the market is down 100 points today, or it's up 150. A lot of times they're looking at the Dow. Okay, now that's only 30 stocks. Okay, so it's not necessarily the best representation of how the overall markets are doing. But it is the 30 biggest stocks and the stocks that most people are familiar with. So that's one that the news media likes to focus on. One down from that's the S&P 500. And the S&P 500 so far this year, and it's an index that we tend to track most often in terms of how it represents the overall market, although we are going to do a deep dive on the S&P and how just a few stocks are moving that index this year. But the S&P year-to-date up 13.64%. In 2022, looking back at last year, it was down 18.13%. at a certain point last year, we saw that bear market happen where we were down over 20%, ended last year at 18. 5-year average though, so even with the volatility we saw last year, even though the volatility we saw during COVID year in 2020, the S&P has done 10.21% per year over the last 5 years. All right, the third one down is the NASDAQ. NASDAQ is a lot of growth in tech stocks, has had a really nice year, up almost 38%. If you look though at 2022, it was down 32%. Okay, so we've seen a natural recovery in growth type stocks and kind of a shift in terms of growth versus value, what's been in favor, what's been out of favor over the last 2 years. So the NASDAQ, while it's had a good year, we're just kind of getting back to where we started the year before. And speaking of that growth versus value comparison, if you see the S&P 500 growth versus value in 2022, growth had a tough year as interest rates spiked much faster than anticipated. The growth type stocks, the tech type stocks had a tougher year. A lot of those companies operate on thin margins, and as borrowing costs go up, the expectations for earnings drop, and that's what happened with stock prices last year on the growth side of things, just like the NASDAQ that we looked at a second ago. Value tended to hang in a little bit better last year at minus 5.25% in 2022. So a big difference between growth type stocks, value type stocks that tend to pay dividends, have stronger balance sheets. Well, look at this year. So on the year-to-date side, growth's up almost 20%, value of about 7%. So we've seen that flip to where in 2023, growth has been much more in favor than value. That's a big spread between growth and value. Historically, they're going to be different, but these are pretty big numbers in terms of how different they've been over the last few years. Some other indexes to point out here, if you look at the Russell 2000, okay, so small and mid-sized stocks here in the US, it's pretty flat for the year, only up 0.26%. Last year, we saw that bear market in Russell 2000 down 20.46%. Small and mid-sized stocks, when the market's more volatile as interest rates go up, again, they also tend to be highly leveraged, but more leveraged, borrow a lot more. And so as interest rates have gone up, that's kind of squeezing the margins. And right above that, you can see the S&P small cap value down 4% this year. We look back, if you remember, in February, March timeframe of this year, we saw a lot of issues with the banks. Okay, if you go to our website, we have a video that Drew put together on the banking issues that we were having at that time. But the main driver of that was interest rates going up. Small and regional sized banks had a lot of losses on their balance sheets because of their treasury holdings and other mortgage-backed security type assets that they had on their balance sheets. Interest rates go up, price of those types of bonds go down. It's that teeter-totter effect. Shane's going to get into that more here in a little bit. But that impact on the balance sheet of small and regional banks is one reason that you see that particular part of the stock market and that index being negative for this year is because of the banking issues that we saw back in February and March. If you remember Silicon Valley Bank going under, that's the type of thing that was going on. Again, we have a video on our website that you can go take a look at to kind of refresh yourself on that. If we look at the MSCI EAFE, Europe, Australasia, and Far East, so kind of our international index, year to date up 5%, last year down about 14.5%. So international markets this year again have been a little bit muted, but it's been nice to see a recovery on that front. Not going to go over every index on here, but you kind of get the pictures that we've seen for the most part, a decent recovery in 2023. A lot of that was the first half of the year. The third quarter was more volatile. But coming off of 2022, we have seen a recovery throughout the stock market. Some areas much better, like growth, a little bit more muted on the value side. But that's That's those some key indexes that we track, and we're going to kind of dive deeper into where these returns are coming from. The Magnificent Seven. All right, so this is a very, to me, very fascinating chart and slide here. When we look at Apple, Microsoft, Alphabet or Google, Amazon, Nvidia, Tesla, and Meta, so Facebook, those 7 stocks have really been the driving factor, driving force behind the returns in the market this year. Okay, so if you look at the upper left-hand corner here, Q1 and Q2 returns, just look at some of the returns just in those 7 stocks. Nvidia up 190%, you have Apple up 50%, Meta up 138%. And over that time, over the first 2 quarters, the first half of the year, the S&P was up 17%. Okay, look at the bottom left. This is the first and second quarter contribution to the S&P 500 returns. We just said the S&P was up 17% for the first half of the year. Those 7 stocks contributed 12.4% of that return. There's 500 stocks in that index. 7 of them made up 12 of the 17% rate of return. Okay. Quarter 3, we saw a little bit of a pullback, all right, in the market overall, but also in these stocks in the upper middle part there. Q3 returns on those 7 stocks. Apple was down 12%, Microsoft down 7%, Alphabet was actually positive, Nvidia positive, Meta positive, and then Amazon and Tesla slightly down. So the S&P 500 in the third quarter was down 3%. Of that 3% drop, 7 stocks again contributed 1% of that loss. That's the bottom middle chart there. Okay, so again, the market going up this year and recovering some has been helpful, and we appreciate it and we like it. Understanding where those returns are coming from are important. So to have that diversification, not just in these particular stocks and just piling into these stocks, is important. We're going to talk about here in a second where stocks are relative to their all-time high, because there's still plenty of opportunity and areas of the market where we can find some value. You can just see the volatility that we could see just from investing in a few stocks. But having that diversification, being in different parts of the market, while these are also helping in kind of our core holdings, our core S&P types holdings, that's nice. But the diversification parts is important. On the right-hand side, year-to-date returns, like we talked about in the last slide, S&P 500 up 13%. So in the upper right-hand corner, you can see what each individual return has been on those 7 stocks. Bottom right-hand corner, of the 13% return so far for the S&P 500, 11% comes from just 7 stocks. Okay, so that's important to understand. Again, is diversification is key, and that you're going to hear us harp on that a lot. But it's been pretty fascinating to see how just a few stocks, which make up a big portion of the index from a weight perspective, how they've driven the market this year. And we'll talk about that weight here on the next slide. All right, so when we look at the index concentration, look at the upper right-hand corner, the weight of the top 10 stocks in the S&P 500. Okay, so 10 stocks out of 500 stocks, the weight, the market capitalization, the size of those stocks, 32% of the index is made up of 10 stocks. Okay, so again, those stocks, when they move, the market's going to move. So the question is, okay, they're that big, they're that important to the index, they must be the biggest earners, the best earners. That's not necessarily the case. They contribute a lot of the earnings, but the bottom right-hand side of this slide, earnings contribution of those 10 stocks in the S&P 500. Those 10 stocks, while making up 32%, they contribute 22% of the overall earnings in the market. So again, if we think of, hey, where are opportunities? Sure, these guys provide a lot of opportunities, but there's also plenty of stocks out there in different parts of the market that provide really nice earnings that may not cost as much. Okay, and that's what the left-hand side of this slide is pointing out. So the PE ratio, or the price to earnings ratio of a stock, is basically what price you pay per dollar of earnings. Okay. The top 10 stocks currently have a PE ratio of almost 26. And you compare that to the remaining stocks, all right? So 490 stocks have a PE ratio of 16.8. The S&P as a whole at 17.8. And what this means is that to purchase shares of those 10 stocks cost more, you're paying more for their earnings than you are the overall index at 17.8. So again, going back to the fact that there is value out there where we could buy other stocks that we consider are still on sale through different parts of the market and different indexes that we think that could perform well going over the next 6, 9, 12, 24 months. There are opportunities out there in addition to just these 10 stocks. All right, I'm kind of harping on this a little bit here, but the point remains that while a few stocks have just really driven the market, there's plenty of opportunities out there. What this chart is showing is that you can see on the right-hand side, the S&P 500 doing 13%. Then you can see the 0% line there in terms of year-to-date returns. Almost half of the stocks in the S&P 500 are actually negative for the year. Not just underperforming the 13%, but they're actually negative for the year, about half the stocks. Okay, so there's plenty of room for recovery in different parts of the economy that we haven't seen yet. We've talked about in previous webinars that different parts of the economy have performed better over the last few years coming out of the COVID lockdowns, where the manufacturing side of the economy seemed to recover quicker because it wasn't quite shut down as much as the service side. So when you talk about hotels and restaurants and airlines and more service oriented part of the economy, they were kind of moving in different directions there for a while. And so there's still plenty of room to run in different parts of the economy, and there's half the stocks in the S&P 500 actually negative for the year. So this is pretty fascinating in terms of the wide range of returns that we've seen in the stock market this year, while still seeing a good return on the S&P 500. All right, so there are 11 sectors in the S&P 500, and so if you look in the upper left-hand corner, you can see what those are, and year to date, what sectors have done what in terms of returns. Okay, so when you look at technology and consumer services on the left-hand side, those have had the best years, best year. All right, on the right-hand side of that, you're looking at utilities, consumer staples, real estate, healthcare, financials, all negative for the year. Okay, so we're seeing, again, wide range of returns in different parts of the economy. So there's always going to be some type of a difference here, but from utilities being down 17 to consumer services being up 45%, pretty big gap. And again, opportunities to find some returns going forward in parts of the economy that may not be doing well now, but should do well over time. All right, and then with our style box, I've already talked about this quite a bit, but on the upper right-hand corner, the way this breaks down is going up and down the right-hand side. You have growth, the G, blend, a blend of growth and values in the middle there, and then V for value on the left-hand side. L is large, M is mid, S is small, in terms of the size of the stocks. So again, you can see large growth in the upper right-hand corner versus small value in the bottom left-hand corner. Wide range of returns there. So the larger the stock and the more growth oriented this year, the better the returns have been. All right, so I referenced this before. If we look at the different sectors in the S&P 500, how far are these sectors away from their all-time high from a price perspective? All right, energy being pretty close to an all-time high on the left-hand side of the chart. You can see industrials about 5% away. And this chart was back in the middle of September, but we're pretty close to this still at this point. Healthcare, 7.8% away. far right-hand side, real estate. I'm not going to spend too much time on real estate because Shane and Drew will talk about interest rates and the economy and borrowing costs and those types of things. But when you have interest rates jump the way they have, 30-year mortgage rates jump the way they have, it's just natural that real estate was going to have a tough time. And we've seen that happen. And so we're 30% away from all-time highs in real estate. And so once interest rates are done going up and potentially dropping, maybe real estate's an opportunity there. Depends on the real estate though, commercial versus residential. So those are things that we're always talking about and looking at internally here in our investment committee. But this is to us, this is a nice chart to say, hey, we've had a decent year in the stock market, but there's still plenty of areas where we can find value and growth going forward. All right. 2023 commodity returns. All right. It's important that we touch on this, and in particular over the last few years with what's happened with inflation. And a big contributor to inflation is with commodity prices. And when we look on the right-hand side, October 6th of last year versus October 6th of this year. Okay, and then in the middle there was the end of 2022. And so oil, we're pretty much where we were about a year ago, a little bit down. Okay, and then you have some issues potentially, to those prices with conflicts going on in the Middle East. And so that's something, again, we're watching pretty closely is how does oil prices, how is that going to impact energy cost, and how does that impact inflation, which then of course goes to what's the Fed going to do with interest rates. So that's kind of the line of thought there. Gas prices almost exactly the same year over year, $3.80 versus $3.78. Natural gas was the one that we saw the biggest decline. So October 6th of last year, natural gas at $6.91, currently right around $3.17. All right, then you have some commodity prices with gold being up slightly this year, silver up a little bit, same thing with copper, corn a little bit down, and overall commodity index slightly down from a year ago. But commodity prices, so them dropping have helped inflation pullbacks on this year. We're going to talk about inflation here in a little bit, but these are also pretty volatile in terms of prices, and they can change from month to month, quarter to quarter. So these are things we're watching very closely and taking this as part of how these prices impact the economy, which impacts the market. All right, I'm going to pass it on to Shane now, who's going to talk about fixed income and key interest rates.
All right, Shane Wolfe, wealth advisor here at Traction, and I'm going to be covering bonds and interest rates. Right now, it's such a crucial part. Everyone's got eyes on the Fed and where bonds are going and where interest rates are. So let's take a perspective on that. So when we look at the top line there in fixed income, the U.S. Ag year to date down 1.7, and actually, excuse me, the 2.36 year to date. And if we look at the 3-year cumulative, absolutely got destroyed, down 15%. So that's just the inverse relationship that Evan was talking about. As or as interest rates go up, the price of bonds go down. And we see that trend even across the US corporates there. And municipals actually have been a decent asset class. If we look at their year to date, they're down 2, but over the 5-year have held pretty well at 5%. If we jump down to the next line there on the 2-year treasury, and we go back to October of 2020, if you bought a 2-year treasury, you're making 14 basis points. So really 14 cents. Doesn't seem like a really good investment. But if we fast forward to today, those same treasuries are at 5%. So we see a significant gain in yield there, which is great. And if we jump down to the 30-year, one thing I like to point out on 30-year treasuries versus the 2-year is 2 years are getting a higher rate of return than you're getting on a 30-year bond. So that's, you'll probably hear that the yield is inverted, and that's what it's referring to there. So we see that you're being more rewarded as an investor to have short-term bonds over the long term. If we jump down to the 30-year fixed mortgage, and we look back at October of 2020 was a great time to buy a home because you can, finance it for 3%. Money was cheap. But if we look to today, this is even numbers have come out. We're at 7.53. We heard today that 30-year rates are almost at 8% now. So much more significant interest payments on a 30-year fixed mortgage. So folks who are, your purchasing power has really gone away from where it was in 2020 till today. And then we look at the prime rate in October of 2020, we're at 3.25 versus today at 8.5. A lot of businesses, when you're out there financing, capital to build a loan for a building or you name it, any type of capital for that, you're paying significantly more for that. So your dollar does not go quite as far. When we look at, yields on the rise of the 10-year US Treasury, and with the narrative of wondering, okay, when is the Fed going to stop raising rates? So this gives us some historical perspective on when they stop raising rates to when the Fed will stop cutting rates. And we look at that, the months before the first Fed cut, going back to 89, took 4 months. And then we look across there, the longest one was after 06, took 15 months for the Fed to start cutting rates again. And what does that do when the Fed starts cutting rates? What does that do to the 10-year? We can see that the 10-year Treasury, significantly went down over there. But let's really put that more and more context and perspective, what that means for an investor. So are you better off having money in cash, core bonds, or long treasuries when the Fed starts cutting rates? So as we see with the cash, those rates of return, if it was me, I would significantly much rather be in core bonds or long treasuries when the Fed is cutting rates, just because of that inverse relationship. When Fed cuts rates, the price of those core bonds and treasuries is going to go up. So we'll see some great return there. So this slide gives us great perspective as we look back on, when is the Fed going to pause or cut rates? So it gives us some encouragement as we look forward. This next slide is a continuation of bonds for the last 40 years, it seems like, have been pretty boring. But in this slide, it just shows us from 2019 on. Now we're actually starting getting yield on our fixed income and bonds. So in September of 2021, the yields you can see were 1.6%. And the duration, that talks about the length of these bonds, 6.5 or 6.7 years. Not too attractive as an investment, but if we fast forward to September of 23, now we're getting 5.4% on that with relatively the same duration. So it makes us wonder what happens if we see the rates either rise, be unchanged, or if rates fall. So if we see rates rise even 1%, that yield will cover basically the drop in the bond price. So your rate of return is pretty neutral. And if we look, even if rates are unchanged going forward, you could take that all the way home to the bank where you're getting 5.4% interest on your bonds. And if rates do fall in the future, that's a best case scenario where we're getting substantial great yield, but then we also have some price appreciation on that bond. So our 1-year total return would be 11%. So I think we're all hoping for that in the future. And now I'm going to pass it over to Drew, and he's going to talk to us about inflation.
Thank you very much, Shane. So I think really the most interesting dynamic in the market and the economy right now is definitely what is the Federal Reserve going to do with interest rates moving forward. And as Evan had mentioned, when we were looking at commodity returns, those have a really big impact on inflation. So this chart that we're looking at here, if we look down in this table down here through August,
CPI, Consumer Price Index, which is kind of the main gauge of inflation that we track, was up 3.6% from a year prior. We've now recently had the release of inflation in September, and it was about 3.7, so pretty much a similar number there. And that's a big difference from just 1 year prior, when we're looking at about an 8% gain. So that's definitely improvement, going from an 8% inflation rate to a 3.6% inflation rate. However, that's not the same as prices actually falling. So we're seeing what's called disinflation, which means inflation is still increasing, but at a lower rate than previously. So we're definitely happy that we're getting some disinflation, but it's not the same as deflation, where prices are actually lower than they were before. So 3.6% on top of 8%, cumulatively speaking, is still a pretty big number. But if we look at inflation since 1980, so about 43 years or so, it's averaged about 3.1%. So we're definitely tracking towards the longer term average. And from a planning perspective, here at Traction Financial Partners, we do normally like to use about a 3% inflation rate. So if you take that 43 year average of 3.1 and take it back even further, it tends to be in the high 2s to low 3s. So we use 3%. We definitely run scenarios with inflation being higher as well, just to kind of stress test our financial plans for clients. But 3% or so is right around the long-term average. And specifically, what's driving inflation currently, we can see it's the price of shelter. And so whether you're renting a home or whether you're owning a home, the cost to pay for living is up at about a 7% clip. So that's the main driver of inflation at this point in time. We can see that that's this yellow line here. It remains the highest of kind of the everyday things that we spend our money on, which is, of course, shelter, food, and energy. So heating and cooling our homes or filling up the tank. It definitely remains elevated compared to the others. We can see food here on this blue line of about 4.2%. It's down meaningfully from its peak about a year ago. In terms of the rate of increase, I think when we go to the grocery store, we're still feeling that food prices are definitely elevated. And then energy, which is kind of that commodity basket that Evan was speaking about, is minus 3.3% over the last year. So Evan showed us oil prices, gas prices are close to where they were about a year ago, but maybe a little bit down. So that's helped brought inflation down. But if we look at the trend line here in red for energy, we're ticking back up. And there's a lot of moving parts to that. Evan mentioned again the conflict going on in the Middle East. If that were to expand, we could definitely see a spike higher in oil prices, which would then translate to gas and so on and so forth. So the picture here is inflation is moving in the right direction. The Federal Reserve targets 2%, so it is still definitely above their long-term target of 2%, but we're trending in the right direction. And what does that mean in terms of what the Federal Reserve might do moving forward? There's about a third. The market is pricing in about a 30% chance that they may do one more 25 basis point hike, so 0.25%. We'll see. We've seen, as Shane showed us, interest rates have been moving up pretty aggressively here throughout the third quarter and certainly into the fourth quarter. So the market's kind of doing the job of the Fed right now. As those interest rates are moving forward, it takes a little pressure off of the Fed. So maybe they don't have to hike. So as Shane just showed us, once the Fed stops hiking, it's normally he showed us, anywhere from 4 to 15 months, so call it an average of 6 to 8 months, before the Fed normally starts cutting rates. And when they start cutting rates, that's when we typically start to see really handsome returns out of our fixed income. And the stock market might cheer that on too. So inflation is still a main driver of where we see things going within interest rates and what the Federal Reserve might do, but we are making progress. and we hope to continue seeing that. One thing not on this page is core inflation, which actually strips out food and energy, because food and energy tend to be pretty volatile in terms of their price changes. Core inflation is still at about 4%. So it's a little higher than the overall inflation because we've seen energy come down a little bit. So we definitely want to see core inflation start to ease a little bit as well. And if this trend line in shelter continues going down, we do hope to see that, because shelter makes up a good portion of the consumer price index, particularly the core side. So we're always keeping a close eye on inflation, and we'll see how that materializes as we move through the fourth quarter here. Now, as Evan mentioned earlier, we are definitely a consumer-driven economy, and makes up about 70% of our GDP. So it's a big deal. We always like to keep tabs on how the everyday consumer is doing, because it's a big driver of overall economic production in our country. So there's a handful of things on this slide. On the left-hand side here, we can see the personal savings rate. So what are people saving as a percentage of their disposable income? We can definitely see that folks back in the 60s and 70s and 80s were saving a little more than we've seen in the last 25 years or so. But the long-term average is about close to 8.5%. In 2023, and this is actually a slight tick up from last year when inflation was really starting to rage, it's at about 4.7. So meaningfully below the long-term average, which just goes to show that the everyday consumer, with this inflation we've been seeing, is having to spend more dollars on everyday expenses, and therefore are no longer able to save quite as much. And this chart here in the top right-hand corner speaks to that. This is called the household excess savings. So basically, how much excess savings do households have on hand? We can see pre-pandemic, it was pretty stable here, right around 1 here. And then in COVID, when the economy got shut down and the government and the Federal Reserve started pumping a bunch of cash into the system, we see these major spikes. So people can't go spend the money, but they're getting a lot of money. So their savings, their excess savings was pretty high. We see that start to turn here in the first part of 2021, when inflation really started to rage. And by the end of 2021, going into 2022, that dipped lower than we saw pre-COVID, and we remain in that area. So again, households are burning through savings, no longer able to save quite as much due to the elevated inflation. And again, this is a big deal because we're a consumer-driven economy. So if the consumer starts to weaken a little bit, then the economy may be weakening with it. And then the last chart here on this page is the revolving consumer credit as a percentage of disposable income. So again, we can see here in the early 2000s, people were paying much more on their credit. Once the 2008 great financial crisis kind of resolved itself, at least to a large degree around 2010, we see that plummet quite a bit. Interest rates were down quite a bit at that point as well. So interest rates on credit cards aren't as high. People are spending less of their disposable income on revolving credit. And that remained pretty stable at around 7% or so, really from about 2012 until COVID. That dropped quite a bit during COVID because, again, people are getting big infusions of cash. They can't spend as much money, so they're not spending as much on credit cards. We've certainly seen that tick up, but still a little bit below kind of that average that we saw back here of about 7%, but definitely keeping an eye on that because that has been ticking up here throughout the last couple of years. And directly relating to that is, of course, where do credit card balances stand? They're at an all-time high. They're north of $1 trillion. This chart, it looks pretty like we've seen a pretty extravagant increase, which of course we have gone up by over $250 billion. But if we kind of look at the longer term trend line, it's pretty much close to that trend line, maybe a little bit higher. So again, people are starting to turn to credit cards. They don't have as much disposable income. So we've seen the consumer continue to spend. They're just now putting it onto credit cards. What's not listed on this slide is that credit card interest rates, APR rates, are at the highest of all time as well, in the mid to upper 20s. So this is also a pretty big deal, and we're keeping our eye on this because as long as people are employed, we're not overly concerned about this chart. Obviously, we don't like the direction it's moving, but if we do start to see people lose jobs, if the economy softens and we see layoffs, this could become a much bigger deal. So something we're keeping our eye on definitely is the overall health of the consumer. And right now, they're not able to save as much. They've kind of burnt through their savings that they had built up through COVID. And now we're starting to put a lot of money back onto credit cards at the same time that credit card interest rates are at an all-time high. To wrap up today's webinar, we want to talk about stock market returns as we go through an election cycle here. Obviously, things are kind of starting to ramp up for the 2024 election. And a lot of folks tend to get nervous around election years because, you know, depending on what side you're on, if the other side wins, you're not feeling as confident about things moving forward. But we have some pretty interesting data here to show that you don't want to play any games of waiting to get your money invested or going to cash just because you're not sure of how an election's going to go. Returns are really strong regardless of where we're at in an election cycle. So we're obviously in a pre-election year here. You can see that the average 4-year return on an annualized basis is just shy of 11%. And the average risk on that is about 14.7. That's a standard deviation measurement there. But if we look at where the average investor is positioned in a year like this, historically, they've been very, very overweight to cash. And you know, they've been hesitant to invest in the market as they want to kind of get a read on how things may go as we're moving into the actual election year. So when we get into an election year, which will be next year, the 4-year return on the stock market is even higher, a little bit above 11%. Standard deviation, or the volatility of returns, are actually lower at about 13.3%, yet we see investors positioned in a very similar way as they are in pre-election years. Again, they're nervous about how the election may or may not go, so they kind of keep their cash on the sidelines. But again, if we're getting 11% a year starting in that year, historically speaking, there's no reason to be nervous about how the election's going to go, and keep your money in cash, and that money could be working for you and earning handsome returns. And then when we get to a post-election year, we can see that investors are a little more comfortable. There's a little clarity about the makeup of the government. So they deploy a good portion of their cash into the equity market, which does reward them. We're close to a 12% annual return in post-election years. If we look at 4 years moving forward, risk gets back to kind of the standard 14.8%. And then finally, in midterm election years, the story remains the same. It just pays to remain invested at all times. So there's always so many moving parts. The media will, of course, emphasize the negative aspects of what's going on out there because that's what gets eyeballs to tune in. But you know, we really want to clear that out when it comes to an investment perspective and remain invested, because we're rewarded regardless of where we are in an election cycle. Returns are always strong. And we will always encourage our clients to remain invested because it's just so difficult to time markets, particularly as geopolitical events are happening, like we've seen, you know, first with the Ukraine-Russia event, now the Middle East tensions. And, you know, we always want to maintain a long-term view as investors, because over the long term, we're rewarded for remaining invested. So that's the final slide that we have here, and we'll allow you to enter some questions into the chat box if you have any. So we'll give you a little bit of time to do so. And while we're waiting for that, I think I'll just kick off with a question for Evan, since he took us through the equity markets. Evan, we know that returns in the third quarter were a little bit negative. And looking at historical data, that's actually kind of in line with what we typically see, particularly for a September. But maybe you can tell our viewers here, how do the markets typically perform in the fourth quarter now that we've entered that?
Yeah, great question. As you mentioned, September historically is the worst month of the year. Okay, and that didn't let us down this year. September was a poor month. Again, in 2023, historically, the fourth quarter is the best quarter of the year. Okay, it doesn't happen all the time, but when we see a market bottom out during the year, a lot of times that comes off of a bad September, sneaks into the first part of October, and usually the first week to 10 days, we see the market bottom in October. This happened last year in 2022. We saw the market bottom at the beginning of October, and then starting probably the halfway through October through the rest of the year. Historically, we see good markets, and the fourth quarters tend to be the best quarter of the year. A lot of times get into the holiday season, we see those consumers get out and spending money and generating economic activity. So we'll see, of course, this year, doesn't have to fall in line with that, but we're open for a good, strong finish to the year. Again, the S&P being up 13% or so year to date. If we can continue that trend and finish strong, I know we'll be happy, clients will be happy, and get us a good start into 2024, which you showed during an election year tends to be actually less volatile and still show decent returns. Okay.
Awesome. Thank you very much. All right. It doesn't look like we've had any questions come into the chat box. So we'll go ahead and wrap up and let you get on with your mornings. We want to thank you so much for your time. We know how valuable it is. And again, we do have this being recorded. So once we get our recording all set, we will go ahead and get that emailed out to everybody and get it on our website. So we encourage you to share this with anyone that you think may get some value from it. And as always, feel free to reach out to us with any questions you may have, and enjoy the rest of your week, and we will talk to you soon. Thank you so much.